The market has been hoping that if the stock market declines, and I think the general public as well have been hoping that if tariffs do force a recession in the US, that Jerome Powell and the Federal Reserve would come to the rescue with rate cuts. And the unfortunate thing that Powell has told the markets in the past 12 hours is that they're going to be potentially unable to do so. Thankfully, for the past 2 years, we haven't seen a situation where the Federal Reserve's dual mandates of keeping inflation low and stable and keeping unemployment in check have been in conflict, but that may become the case.
Well, Jerome Powell said that we may find ourselves in a challenging scenario where our dual mandate goals are in tension. Does that mean stagflation?
He is referring to stagflation, and he's warning people that it will not be easy for the Federal Reserve to just look through the price pressure this time. So the hope was that if the Federal Reserve could look at the inflation pressures as a result of the tariffs and say, this is specific to the items that were hit with the tariff, and it's going to be transitory, and it's not going to be baked in inflation expectations, then they could look through it, especially if it was just a step change in prices and for a short period of time. But this actually isn't what we have seen with tariffs in the recent history in the US. So a great example is in 2018. The US put tariffs on washing machines and not dryers. And so you'd think, and economists expected, that what you'd be able to see is that there'd be a step change in the price of washing machines and then inflation would return as normal. But actually none of those two things happened. The first thing that happened was the increase in prices was slow, sustained, and not just transitory, but it became permanent. And the second thing is it wasn't just washing machines that saw an increase in prices. It was washing machines, dryers, and all other white goods. So the ability of the Fed to just say this is not going to become embedded in people's inflation expectations is probably going to be muted in this cycle.
And his language was stronger on inflation in relation to tariffs in this speech.
Yeah, that's right. So I think he said firstly that the tariffs were larger than they were anticipated. And the other thing that's problematic for the Fed is we've already seen inflation expectations become unanchored. So the University of Michigan surveyed general consumers on what they believe inflation will be for the next 5 to 10 years. And it's worse now than it was just after exiting COVID.
Well, Jay Powell said life moves pretty fast, and I know you wanted to reference Ferris Bueller's Day Off, so I'll let you do that. But at the moment, a full rate cut is priced in by July in the US. Could there need to be a hike?
Probably not that soon, but there is the potential that by the end of the year, the Fed would be forced to take the action that they really don't want to take, which is they might even need to tighten monetary policy. Now, yeah, his Ferris Bueller reference, he said life does move pretty fast. That was quite serendipitous because in the movie Ferris Bueller's Day Off, there is an economics lesson and they're talking about how the Fed was forced to tighten interest rates after the tariffs that were put in during the Great Depression. And all that did was make the Great Depression worse. Now, this is the Sophie's choice that the Fed might have to face in the next year, is if inflation expectations become unanchored, they may have to act to make the unemployment rate rise even further than it otherwise would, because their primary responsibility is to keep inflation in check.
And what do you think? I mean, is it just too uncertain at the moment to make predictions?
Yes, it is too uncertain at the moment to make predictions, but the problem is the market is already making a very clear prediction. And the market's prediction is that the Fed will cut rates this year, 3 times in fact. And I think the problem is that prediction is the one that's more likely to be incorrect. We're more likely to see the Fed have to keep rates unchanged for the rest of the year. And that's a tightening relative to the market's expectations, which will not play out well.
Does that translate to Australia? Because we have markets pricing in a big cut in May and then a number of cuts after.
Yes, it does. So I think that there's already too many interest rate cuts priced for Australia. So for starters, the market thinks there's a chance of a supersized 50 basis point rate cut in May. I think that's extremely unlikely to occur. And the reason is that the RBA is facing the same dilemma. In fact, we have an output gap that's positive. So in other words, we think the economy is running too hot, above potential. We're coming into this with the potential for a trade shock to slow Australia's economic growth down. But at the same time, we've also had inflation running outside of the target band on an underlying basis for almost 4 years. The RBA is going to be very reticent to deliver too much easing, which would make inflation sticky and permanent.
Andrew Lilley, thank you.
Thank you, Alicia.